Hi, in this video, I'm going to talk about the gain exclusion when you sell your home, which is your primary residence. So for IRS code, it's section 121 is a personal residence. So basically, if you sell your personal residence, they have you can exclude if you are single is $250,000 capital gain in your income, so you do not pay tax on this $250,000 gain. So if you are married and file jointly, you are eligible for $500,000 exclusion. However, it's lots of details. You have to meet certain tests. So let's dive into the detail. Let's see. Say currently, Section 121 allows for gain exclusion up to $250,000, $500,000 for married file jointly to any taxpayers who satisfy certain tests, known as the ownership test and the use test. Ownership and the use test say the home must have been owned and used as the principal residence for at least 2 of the 5 years preceding the date of the sale. So basically, if you sell today, so last 5 years until today, so 2 of the 5 years you have to be the owner. Then you also lived in the home as primary residence. However, this is very interesting. Say you still, 5 years as a primary residence. The things there's another situation is like called non-qualified use. So I'm gonna talk about details. Say last 5 years, even you are 2 and 5 years was the owner, and you lived there as a primary residence, you still not qualify. So that's just another situation. However, so in normal situation, if you own 2 years out of 5 years, so then most of the situation you are eligible for the exclusion. So then for married couple is very interesting. Either couple can meet the ownership test, but both must meet the use test. So this is very interesting. Just to say, well, if you're married couple, husband and wife, so if only the wife owns the house for 2 years, then you are good. You are satisfied for the ownership. The husband doesn't have to be owner for the 2 years. So that's satisfied for the ownership. However, even the husband didn't own it, but he has to living there for 2 years. So that's the thing. So later I'm gonna show you an example on this. So basically here just a little tip. Say, well, if in a divorce or in a situation, separate situation, so you have to pay attention to this. Say, well, later you want to sell, you may not qualify for exclusion. It's very interesting. This is $500,000 for a married couple. It's not together. You can use as individually. One may qualify, the other one may not qualify. So the qualified one is still eligible for the $250,000. So it's used separately. If the taxpayer fails to meet either test because of changing in employment or health, the taxpayer may be entitled to a partial exclusion based on shorter of the taxpayer use of the ownership. So this is just a little exception. just say, well, so you bought a house a year ago, so then your company suddenly transport you to a different state or different country, so you have to sell your house. In this situation, you may not qualify for 250,000 dollars the entire exclusion. You may qualify for partial. If you live in there for 1 year, one out of two, so you may qualify for 50% of the $250,000 exclusion. So that's basically, that's a little exception there. So that's, here is the married couple situation. It's, let's see, Mary and Ben, both middle-age, get married, and Ben moves into the house that Mary has been using as her primary residence for 7 years. The home is retitled into both of their name immediately. 9 months later, Ben gets a job promotion and moved to the new city. They realize again $700,000 Mary's residence. Mary has made both ownership and use test, but Ben has not. Therefore, Mary tested for exclusion $250,000 taxable gain. However, because Ben has been in the house only 9 months, he is eligible for an exclusion only $93,750, which is, you can see, 9 months out of 2 years is 24 months. So their total of $250,000. Their total exclusion is Mary eligible for $250,000, Ben only is $93,750. So this gives them eligible exclusion is $343,750. So they must pay tax on the remaining gain is $356,250 gain at the gain rate. So you can see here, married couple, they can do completely separately. Mary's situation is different with Ben. So Ben only allow partial. Mary allow the entire amount exclusion. So you can see there. So a little tip here say the gain exclusion may be used once every 2 years. So this one, so basically, so within last 2 years, if any one of them, let's say if Mary within last 2 years, she used all her $250,000 exclusion, so she won't be able to use in this house. So that's just something. With any other personal assets, losses of the sales personal residence are not deductible. So yeah, so basically this is it's very interesting. The government tax you on the gain. They won't allow you to, if you sell at a loss, you cannot deduct it. So this is non-qualified use I talked about earlier. Let's just read through this. What does that mean? Non-qualified use is any period for which the property is not used as a principal residence, during which the taxpayer does not live in the home. Also included that period of the rental and the vacation homes usage of the resident. So basically, non-qualified use, say you have a rental property. You've been on this rental property for many years, for last 10 years. So you have a tons of gain on the property. You have, let's say $500,000 gain on it. So you will think about, say, if I convert this rental property to a primary residence, so then I can, I move in, living there for 2 years, so then I can use the, $250,000 or you're married $500,000 exclusion, so that will, avoid all the taxes. the things that government know you're gonna do that, so you are not eligible. So the 2 years you living there, so prior to that 2 years, basically within 5 years, the 3 years prior to 2 years are considered non-qualified use. So you are only allow portion of this exemption. You are not eligible for the entire $250,000 exclusion. So yeah. So on IRS publication 523, there's worksheets you can work through to figure out how much you are eligible. So the home sale exclusion is not available for the period non-qualified use, even though the 2 out of the 5 years ownership use tests are otherwise satisfied. So basically tell you that last 5 years, first 3 years you use as a rental property, or you use as a vacation. Then then you move in for 2 years. So even your 2 years are certified, but you are not qualified for the entire exclusion. So this restriction is meant to prevent the taxpayer from converting rental property or the vacation home into a principal residence and using exclusion again within 2 years after sale of the principal residence. So that's why it's there called non-qualified use. Okay, here is a vacation home rental rule. So basically some people, they own some vacation home, so they may use it for themselves partially, they then rent it out partially. So the federal government, IRS, have a special rule for this. So basically say if you this vacation home, you will rent it out less than 15 days a year. So basically rent it out less than 15 days a year. This is called personal use. So you whatever you made on this rental, you do not need to include your gross income. You do not report the income. So then you do not get deduction on any mortgage interest, and the taxes do not get any recognized as gain. So basically tell you, so this is not a business rental. So basically it's your personal use. We do not you do not include the income, but you also do not report any losses, get deducted any expense on it. So the second one is rental use. Rental use, basically you rent it out 15 days, then you personal use. Personal use is less than 14 days, or the 10% of the total rental days. Let's just say, well, you total rented out is 250 days a year. So your 10% is 25. 10% is 25 days, right? So if your personal use is less than 25 days, and your rental is more than, of course, you rent it out 250 days, so it's way more than 15 days. So this is rental use. When it's rental use, kind of is a business. So you allocate expense between the business and the personal. So then can deduct losses up to $250,000. However, this $250,000 is phasing out if your AGI, so you have a salary, if you have a salary, you have right, so then you have an income, other income. So your AGI, if higher than $100,000, then less than 150. So you will not, basically your AGI if greater than $150,000, you are not eligible to recognize any loss on your rental property. Basically that's what we're saying. Then the mixed use. So basically say if you rent it out more than 15 days. However, then your personal use is also greater than 14 days, or 10% of your rental. So if you, let's say you rent it out for 250 days, however, you used more than 30 days. And so in this case, so that this is called mixed use. Mixed use, first thing you need to know, difference is from the rental use you allow $250,000 loss, then the mixed use you cannot deduct any loss. So that's something. So you do allocate expense between business, personal, deduct expense in order of the mortgage interest tax operation, then the depreciation, the Schedule E, deduct the personal portion of the mortgage interest real estate on the Schedule A. So report income expense on the Schedule E. So basically, like a rental side on the Schedule E, on the personal side on the Schedule A, 1040. Here's a example regarding the mixed-use vacation home. Let's say Aaron and Julia own a vacation home located on the beach. They rented the home for 4 weeks during their year lasts at a rate $800 per week. So they use the home personally for 16 days. You can see it's more than 14 days, right? More than 14 days, then more than 14 days, also 8 weeks. 8 weeks is, 8 weeks, you have to rent it out more than like 160 days. So this one is still 10%. 8 weeks, 10% is less than 16 days. So anyway, so you basically tell you it's a mixed use. It's a mixed use in this situation. They allocate rental expense $8,000, $5,000 for the mortgage and the interest, property tax $3,000 for other expense. So their total expense is $8,000. So they're under the mixed use rule, they incur loss. Here, their rent income is $6,400. So then they get deduct expense $8,000. So then they have a loss is $1,600, right? So the loss is $1,600. So in this case, because they are mixed use, so this is $1,600 cannot be recognized as a loss to offset your income, but they do allow to carry forward to the future. If you have any other, in the future, if you rent more, you recognize more rent income than expense, so you can use this expense to offset the rental income. However, you cannot use this $1,600 to recognize as the loss to offset your other income. So basically, that's something. Let's say the calculation for the allocating expense in the mixed-use rental has been subject to distributed by the IRS, and the client should be advised to seek qualified tax advice before determining which method they should use. So yeah, so kind of a little complicated. So if you want to do that, so you should do more research on it, handle it carefully. So for additional information, anything regarding selling your home, any gains, anything, cost basis, stuff that like that. So this is IRS publication 523. It's a very, very good resources for you to research on that before you do anything.